Yeah, good evening, ladies and gents. On a quiet day on the market, but as expected on a Monday. All right, so today's session really is just going to focus on supply demand, or better known as institutional order flow, and that's going to be the main topic for today. So I'll just head on over to that. Okay. All right, as you know, disclaimer, you can read up on that, on the entire disclaimer part on the website. Okay. Now, supply and demand. All right. Now, as a simple, not too elegant explanation of supply and demand. So, what we need to know is on each and every transaction, whether it be foreign exchange, indices, or any sort of market, you basically okay, so just give me a sec, guys. And people just tend to jump in a bit later on. Okay, so as I was saying, then in terms of supply and demand, that's really what controls the market. Okay, it's a matter of who's buying and who's selling, and mostly what you're going to be doing is just trying to identify those levels where there's buying opportunities. As we all know that obviously the smart money or the big money will move the markets, especially shorter term. They'll be able to swing the markets, and the patterns are identifiable based on that. Right, now looking at these institutional areas or institutional order flow as it's known, will help us to actually decipher where the big players are getting in and where they're getting out potentially. Right, now each successful transaction has both a buyer and a seller, sort of like laptop and if let's say you're a supplier of laptops and your job is to supply people with laptops and stuff like that. And now in order for a transaction to be complete, let's just say you just for interest rate, we charge $100 for each and every laptop. Okay, so if you sell your laptop for $100, obviously you need to buy it at a cheaper price. You need to buy it for either anywhere from $99, maybe $80, $85, depending on how many of the actual quantity that you get. All right, now it's similar to trading. And that you try to profit obviously off you're buying when you believe that the price is undervalued or the market is undervalued. And when you feel like it's overvalued, then you're looking at selling opportunities. Now, that all can be read on technical analysis. You can clearly see these levels if we understand the institutional order flow. Right. Now, the large institutions have more influence, as I said, on the price, especially short-term price change. That means on an intraday level, your markets will be shifted, right? Will be a lot more manipulated as opposed to your larger time frames, because obviously there can be intervention from central banks and other things that influence, let's say, interest rates and all of that stuff. Those mostly aren't going to be in the control of the larger institutions, but will be, let's say, will given a lot of other or will be all right, let me just say price will be derived of a whole different set of aspects. For instance, larger speculators, right, or institutions looking to invest, or just regular investors, people who are looking to safeguard their money. They might put it in a particular currency pair, and that will obviously mean that the currency pair, and if let's say the central bank says wants to, I don't know, weaken that currency. Obviously, that currency is going to weaken if the central bank says it wants it to lose its value. So, on the larger frame of things, obviously, you're going to need to branch out and delve into what the central banks are saying more. But on a short-term basis, obviously, those supply and demand areas will play a major key. Now, different traders are on one end of these transactions for different reasons. Like I said, it might not just be for to making profit. It might be a transaction, buying a yacht, for instance, $1 billion yacht from Russia. Right. Apparently they make good yachts. And buying that yacht for $1 billion, that simply means that you're going to need to change your billion US dollars for how many rubles? I think it's rubles. think it's 45 rubles to $1, something along those lines, something insane. So now that's not clearly to make profits, right? But it is something that's gonna affect, especially the shorter price action, and it may influence a bit on the longer term in terms of investment. That will influence the longer term interest rates and how the actual economy is doing. Okay, but for now, we're just going to mainly look at technical side on a short-term scale. Now, supply and demand exist in every market. Therefore, the supply and demand theory can be applied in any trading market. So you'll be trading indices. You can trade, I don't want to say forex. You can trade equities. You can trade bonds. You can trade T-bills. You can trade interest rates. Anything you can trade using all of this, what I'm about to actually delve into in terms of supply and demand, because it is really a universal market. It's in every single thing. It's in day-to-day life as well. If there's a huge demand for something, obviously the price will rise. Look at Bitcoin as well. There's a huge demand for it, and then obviously people are scared and a bit skeptical, and the fear gauge is a bit high. Obviously, they'll start dumping those Bitcoins on the market, and then it will drop. So it's really just a supply and a demand equation. Now, the critical factors that influence supply and demand abroad, right? So we'll look at just excessive buying and selling from major institutions. So, like I said, in the next two modules, I believe, that we're going to be doing, I'll delve into the fundamental aspects that influence supply and demand. But for now, it's just going to be a matter of trying to figure out how the major institutions buy and sell at certain levels. Because if there's one US dollar person buying and there's one person selling, obviously that really won't influence the price that much. Okay, you guys are still with me? Okay, right. So uh, okay, right. So okay, right. Sorry, I think my laptop is a bit dazed today. Right. So I don't know what this is though. I don't know who this looks like. It looks like sauce or something. Okay, but in any case, guys, this is essentially the supply and demand equation explained in one graphical illustration. And this simply means, obviously, that if the supply is equal to the demand, the price really won't go anywhere. Okay, but if there's an excessive amount of demand for anything, obviously the price will rise. And if there's an excessive supply of it and there's too much of it, then the price will then drop. Right. So it's important, it's critical for you to understand this, because really that's what goes on within a day-to-day structure or the day-to-day price action or technical analysis side of things. You'll be able to read it, because when one institution sells at one level and another buys here, the market will just oscillate around these areas. But if it's then a matter of they sell, sell, that's really what drives price down. Okay, because if they sell, another buys, then that's fine. But if they sell, and people are actually buying up at these levels, and it's just an excessive amount of selling and dumping on the market, that will in turn cause the market to rally, to rather fall off a cliff. Okay.